The recent stock sell-off might seem alarming to some, but I see it as a healthy correction. The market was due for a pullback. We had seen a period of exuberance, with stock prices rising faster than underlying economic fundamentals. This kind of disconnect cannot last forever. A correction helps to reset expectations and bring valuations back in line. It's like letting air out of an overinflated tire. This prevents a larger, more damaging burst down the line. So, while some investors might be worried, I believe this correction is a positive development for the long-term health of the market. Think of it as a reality check for investors. The market got ahead of itself, and now it's catching up to the economic realities. This doesn't mean the bull market is over. It simply means a period of consolidation is necessary for sustainable growth. The Federal Reserve's recent cautiousness about future rate cuts has also contributed to the sell-off. The Fed's stance is another reality check for the market. Investors were perhaps too optimistic about aggressive rate cuts in the near future. The Fed's primary mandate is to control inflation. They have made it clear that they will prioritize this over market sentiment. This means they will be data dependent and will only cut rates when they see clear evidence that inflation is under control. The Fed's cautious approach is understandable. Inflation remains a concern, and prematurely cutting rates could reignite inflationary pressures. This would be detrimental to the economy in the long run. Current economic indicators suggest that inflation is stickier than anticipated. The core PCE price index, a key measure of inflation, remains above the Fed's 2% target. This supports the Fed's cautious approach to rate cuts. While some market participants were expecting multiple rate cuts in 2025, the Fed has signaled a more gradual approach. The latest projections suggest 2 rate cuts in 2025, with a possibility of even fewer cuts if inflation doesn't cooperate. This slower pace of rate cuts is a departure from the market's earlier expectations. This explains the recent market volatility. Investors are readjusting their portfolios to align with the Fed's more measured stance. The market reaction to the Fed's revised outlook has been noticeable. Major stock indices have declined, reflecting the reassessment of future rate cut expectations. This is a natural consequence of the Fed's communication and the market's adjustment to the new information. Going forward, I expect the market to remain volatile as investors navigate this period of uncertainty. The Fed's pause phase in monetary policy, where it's neither hiking nor cutting rates aggressively, will likely continue until there is more clarity on the inflation front. However, I remain optimistic about the long-term prospects of the market. The current sell-off is a healthy correction, and the Fed's cautious approach, while initially causing some volatility, is ultimately the right course of action to ensure sustainable economic growth.